Hey managerial accounting students, I'm hoping you've got a good grasp on Chapter 2 and are ready to dive into Chapter 3. In Chapter 3, we're going over a lot of the same concepts from Chapter 2, but we're going to add in debits and credits and journal entries and a little bit more. All right, let's get started. So in review, we've got some vocabulary terms I want to just go over briefly. First of all, we know what job order costing is, I hope. A costing system used in situations where many different products, jobs, or services are produced each period. In Chapter 4, we'll look at a different method that's for when we have somewhat homogeneous product. So job order costing we use when there's different products, each job or product is somewhat unique, and therefore it's worthy of tracking our materials, labor, and overhead separately by job. Absorption costing, which is the only type of costing you're really aware of at this point, is a costing method that includes all manufacturing costs. So the direct materials and direct labor, obviously, and both the variable and fixed MO in the cost of a product. The point in there that's negotiable is the fixed MO. And in a later chapter, we'll look at a different method that essentially we look at the argument, does fixed MO really belong as a product cost? But for now, we include all of it, and that's called absorption costing. So when we look at our predetermined overhead rate, we need to understand a couple terms. Our allocation base, so that's the measure of activity like direct labor hours or machine hours that we use to assign costs to cost objects. So it's the denominator when you're computing your predetermined overhead rate. And of course, the predetermined overhead rate is the rate that we use to charge MO to jobs. And we're going to establish that in advance for each period. And we're going to compute that by taking, remember, the estimate divided by the estimate. The estimated total manufacturing overhead divided by the estimated total amount of the allocation base. More vocabulary. When we talk about overhead application, that's the process of assigning overhead costs to our specific jobs. So we're taking that predetermined overhead rate, which was an estimate divided by an estimate, but then we're multiplying it by the actual amount of allocation base incurred by that job. Then we have normal costing, which is a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of allocation base incurred in the job. I think that's what we're doing. I just don't know that we had put a term to that yet. So normal costing is what we've been doing. Maybe we weren't aware of the vocabulary term there. And then finally, the job cost sheet is a form, or it could be a computer record, where we record our direct materials, direct labor, and the MO assigned to each job. So next, we want to get a more in-depth look at understanding the flow of costs in a job order costing system and be able to prepare the appropriate journal entries that go with that, and the T accounts. So whether you like doing the T accounts first or the journal entries, doesn't really matter, but we need to be comfortable with the flow through a job order costing system. So as you guys know, we've got 3 different types of inventory now. We have raw materials inventory, so that's the materials that go into the final product. Then we have WIP inventory, which consists of units of production that are only partially complete and require further work before they're ready for sale to customers. WIP is where we add in our raw materials, our direct labor, and our MO. So that's where everything gets gathered. And then once the product is finished, it moves into finished goods inventory. So that's our completed units of product that have not been sold to customers. So it's still inventory. And then a new term, cost of goods manufactured. It includes the manufacturing costs associated with the goods that were finished during the period. That's an important one, the goods that were finished during the period. Not necessarily the ones that were started and finished, but anything that was finished during the period. We're going to continue to talk about cost of goods manufactured, or what we call COGMAN for short, because I know how you like more abbreviations and acronyms. So overview, we've got our product costs, raw materials, direct labor, and mow. And then we have our period costs. So let's see where they all end up. So our raw materials start as raw materials as inventory on the balance sheet. And then they get requisitioned into a particular job and they move into WIP. And then we add in our direct labor and our mow also into WIP inventory. And then when it's done, when we're done working on that product, it goes from WIP into finished goods inventory. And this little note right here where it says goods completed, cost of goods manufactured, that's a really important and great reminder for us. The transfer from WIP to finished goods, that amount represents cogman. That's our cost of goods manufactured. Those are the goods that were finished during the period. So then there it sits in finished goods inventory, and then once we sell it, then it moves to cost of goods sold, the expense on the income statement. And then in contrast, down here at the bottom, we have our period costs, selling and admin costs. That's where all of our non-manufacturing costs would go. And those just get expensed directly in the period in which they're incurred. So period costs get expensed in the period in which they're incurred. Notice they don't take a stop on the balance sheet. They happen and we expense them. So we're going to look at this example with Ruger Corporation. So we've got Ruger Corporation's transactions for the month of April. They're a producer of gold and silver commemorative medallions, and they only worked on 2 jobs in April, conveniently Job A and Job B. So Job A, a special minting of 1,000 gold medallions commemorating the invention of motion pictures, was started during March and completed in April. As of March 31st, Job A had been assigned $30,000 in manufacturing costs, which corresponds with Ruger's WIP work in process or WIP balance as of April 1st. So that's our beginning WIP, $30,000, all of which belongs to Job A. Then we have Job B, an order for 10,000 silver medallions commemorating the fall of the Berlin Wall, and that was started during April and was still incomplete at the end of the month. So the end of the month, Job B is still going to be in WIP. So let's take a look at our raw materials. So in our raw materials, when we purchase the raw materials, that creates a debit to raw materials. And then we're going to be requisitioning materials into our jobs. So direct materials are going to go into WIP, and then indirect materials go into mow. Now remember, mow acts like an asset for debits and credits in terms of our journal entries and T accounts. But remember, the mow bucket doesn't actually exist on any financial statement. So it acts like an asset. It's where we gather all of these costs, but at the end of the period, we have to dump it out. So the debit side represents our actual costs, and then the credit side is going to represent what we apply into our jobs. So in journal entry form, on April 1st, Ruger Corporation had $7,000 in raw materials on hand. During the month, the company purchased on account, remember on account, that means we don't pay for it yet, on account, an additional $60,000 in raw materials. So we debit raw materials, making the asset go up, and then we credit accounts payable, making the liability go up. So then, during April, materials requisition forms were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. These raw materials included $50,000 of direct and $2,000 of indirect materials. So this entry below is going to record issuing those materials to production departments. So raw materials, the credit at the bottom, that's the full $52,000, making the asset raw materials go down. So where do those materials go? Well, $50,000, the direct materials, go into WIP. Okay, there is no account called direct materials. So the direct materials go into WIP. We debit WIP. The indirect materials, again, there is no account title indirect materials. Indirect materials go into mow. So we're debiting mow. So we've increased WIP by 50,000, we've increased mow by 2,000, and it all came out of raw materials, the sum of 52,000. So next we're going to take a look at labor. So when we record labor, our labor is going to start from salaries and wages payable. Okay, so we're going to assume it's all on account. We're going to pay it later. And unlike traditional financial accounting, we don't just expense our labor costs directly because these are manufacturing costs. They become part of our product cost. So direct labor is going to be a debit into WIP going into each job, and then a credit to salaries and wages payable. And then our indirect labor is going to create a debit to mow, and again a credit to salaries and wages payable. And we'll make sure we pay those workers when they're due on payday, but for now it'll just sit as a liability in salaries and wages payable. So looking at Ruger Corporation, in April, the employee time tickets, which provide hourly summaries of each employee's activities, included 60,000 recorded for direct labor and 15,000 for indirect labor. The following entry summarizes these costs. So the direct labor, again, direct labor is not an account title. Direct labor goes into WIP. So we debit WIP 60,000. And then indirect labor, also not an account title. Indirect labor goes into mow, so we debit mow, and then we credit salaries and wages payable for the sum. On most of the problems you'll find in this text, they want you to do things on account, so we use salaries and wages payable. It's possible that they actually pay them right then, and you could find yourself crediting cash, but for the most part, you'll see that things are on account, so it's salaries and wages payable. So then we have our mow. So considering our mow, we've got our indirect labor and our indirect materials that have been accumulated in mow so far. And then we have to think about the other overhead. So lots of other things are going to go into this mow bucket. So assume that Ruger Corporation incurred the following general factory costs. So these are other factory costs. Utilities, 21,000, rent, 16,000, and just miscellaneous factory overhead, 3,000. And again, they want us to do this on account, but they note down here at the bottom, accounts like cash could also be credited. If it said it was for cash, then we credit cash, but this time we're going to do it on account. So all of these costs, the 21, the 16, the 3, we add it all up. We debit mow for 40,000, and we credit accounts payable for 40,000. So then we need to think about how we're going to apply mow into WIP. And so that process will be, we'll have to compute how much overhead we're going to apply to WIP, but we're going to be debiting WIP and then crediting mow, bringing the balance down in mow. And remember, at year end, we want the balance in mow to equal exactly 0. So if actual and applied manufacturing overhead are not equal, a year-end adjustment is required. And newsflash, they will almost never be equal. Remember, we're applying mow based on the POR, and the POR is computed by taking an estimate divided by an estimate. So the likelihood of us being spot on and mow just working out to 0 is really minimal. Highly unlikely that that would happen. So we need to plan on examining mow at the end of the year and figuring out if we need to make that year-end adjustment. So assume that Ruger Corporation's predetermined overhead rate is $6 per machine hour, and assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours were worked on job B. So that's a total of 15,000 machine hours. So that makes 90,000 in mow. We're going to take $6 per machine hour times 15,000 equals 90,000. So that's where the 90,000 is coming from. And we're going to apply that from mow into WIP. So that's a debit to WIP, 90,000, and a credit to mow, 90,000. So then we're going to deal with our non-manufacturing costs. And there's plenty of these in a company usually. Non-manufacturing costs are not assigned to individual jobs. Rather, they are expensed in the period incurred. They're period costs. So they're not going to go through product costs. They're not going to go into WIP on the balance sheet. They just get expensed. So the salary expense of employees working in marketing, selling, or admin capacity get expensed during the period. And then advertising expenses just get expensed during that period. So they'll show us what that should look like. And this probably looks a little more like traditional financial accounting that you're used to. So here they say Ruger Corporation incurred $30,000 in selling and admin salary costs during April. So we've got debit salaries expense, credit salaries and wages payable. Then they tell us they had depreciation on office equipment. Now, if it was factory equipment, that would be different. That would go into MO. But this is office equipment. So we're going to debit depreciation expense, credit accumulated depreciation. And then finally, they tell us advertising was $42,000 and other selling and admin expenses in April totaled $8,000. So we debit advertising expense. We debit other selling and admin expense. I don't much care for that account title, but that's what they give us. And then we credit accounts payable. And they do remind us, okay, so these don't have to be payable, salaries and wages payable, accounts payable. It could be cash, but again, unless they tell us, we're going to assume it's on account. Most of these problems are going to be done on account. So then finally, when we are done with a job, we're going to transfer the WIP for that job into finished goods. And that dollar amount that we're transferring, that is our cogman, that is our cost of goods manufactured. So when we finish job A, it's going to move from WIP over to finished goods. And that would be a debit to finished goods and a credit to WIP. Okay, so a debit to finished goods and a credit to WIP. And this transfer is cogman. It is cost of goods manufactured. So job A was completed during April and job B was incomplete at the end of the month. Thus, the following entry transfers the cost of job A from WIP over to finished goods. So we're debiting finished goods, $158,000, crediting WIP, $158,000. Because job B was not completed by the end of the month, its assigned cost will remain in WIP and carry over to next month. If a balance sheet were prepared at the end of April, the cost accumulated thus far on job B, which is $72,000, would appear in the asset account WIP. So that's going to remain as WIP inventory on the balance sheet. That's job B, while job A has been transferred over to finished goods as of right now. Then we'll have to see if we sell job A. And then when we do sell a job, it moves from finished goods inventory over to cost of goods sold, the expense on the income statement. And that transfer, that is our cost of goods sold. So let's see what that looks like to make that sales entry. I'm hoping you remember sales entries from financial accounting, where we do part A and part B. So for Ruger Corporation, we will assume 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for total sales revenue of $225,000. Because 1,000 units were produced and the total cost of the job from the job cost sheet was $158,000, the unit product cost was $158,000. So what they're telling us in terms of computing our cogs, we're going to take 750 units times, right, 750 units from up here times $158, and that's going to be our cogs. So when we make the sale, we do A and then B. So part A is where we recognize the sale and the payment method. And when I say payment method, I mean cash or accounts receivable. So in this case, we're debiting accounts receivable for $225,000, and then we're crediting sales revenue $225,000. And then immediately we do part B, which is where we relieve the inventory. And if we think of the matching concept, I know that's your favorite gap. You remember the matching concept? The third part of the matching concept says sometimes, but not always, we want to match our expenses to the revenues they generate. Well, now it's time to expense the product costs associated with this sale. So we take 750 units times 158, we come up with 118,500, and we're now going to remove that from finished goods inventory, and we're going to expense it to cogs. So we debit cogs and we credit finished goods inventory. I see too many students who miss this journal entry on their test, because this journal entry is on your test. Make sure you practice doing it A and then B. I really don't want to see B and then A, and I really don't want to see A, B, A, B. I want you to do it just like this. Part A, we record the sale and the payment method, and part B, we relieve the inventory. So our next task, we need to prepare schedules of cost of goods manufactured, that one's kind of new to us, and cost of goods sold, and an income statement. So we're going to walk through that process nice and slowly. So the schedules contain 3 types of costs, the same 3 we've been talking about: direct materials, direct labor, and MO. These schedules are going to calculate the cost of raw material and direct labor used in production, and the amount of MO applied to production, and the manufacturing costs associated with goods that were finished during the period. So that's the schedule of cost of goods manufactured. It's going to show you the cost associated with the goods finished during the period. So let's take a look at the cost flow. So if we're looking at our raw materials, we take our beginning raw materials, we add the raw materials purchased, and that gives us our total materials available for use. We subtract the ending raw materials, and therefore that gives us the raw materials used in production. Now, I know that seems like a lot of information. I get students to say, well, do I have to memorize that? I don't think it's something that you memorize, but I think it's something that's really more common sense if you think of it. So for example, if we start the period with 2 apples, and then we buy 3 more apples, that means we have 5 apples. At the end of the period, if I tell you there's only 1 apple in our ending raw materials inventory, how many apples got used or eaten? The other 4, right? So we have to be able to account for our materials and understand where they've gone. So you take the beginning plus what you purchased, and you get your total raw materials available for use. And then at the end of the period, you look at how many you have left, and anything that's not there must have been used. So that's our raw materials used in production, and that should equal our direct materials that goes into manufacturing costs. So then we add in our direct labor and our manufacturing overhead, and that gives us our total manufacturing cost. And if we take a look at our WIP account, we take our beginning WIP plus our total manufacturing cost, and that should equal our total WIP for the period. So then if we look at what's remaining in WIP, our ending WIP balance, anything that's not there then is gone. That means it was finished and transferred over to finished goods, and that's what we call COGMAN, cost of goods manufactured. So anything that is finished, anything that makes that transfer from WIP to finished goods is cost of goods manufactured. So then we see cost of goods manufactured go up here into finished goods. So we take our beginning finished goods inventory, the cost of goods manufactured added during the period, and we get our total cost of goods available for sale. And then if we subtract out our ending finished goods inventory, what's remaining for sale, everything that's gone then has moved on to cost of goods sold. So then it gets expensed as cost of goods sold on the income statement. So if it's not there, if it's not remaining in ending finished goods, it must be gone and sold. That's the point there. I know that seems like a lot, and these couple slides are good ones to study just to understand the flow, but I particularly like the next few slides that are really going to walk us through these steps. So as you're doing your homework, if you're getting confused, I would encourage you to come back to these next couple slides, quick check, and hopefully this is going to give you the confidence that you need to walk through these steps and realize, hey, it's not that hard if I just think it through one step at a time. So try this one out, guys. Quick check one. Beginning raw materials inventory was $32,000. During the month, $276,000 of raw materials was purchased. A count at the end of the month revealed that $28,000 of raw materials was still present. What is the cost of direct materials used? Go ahead and hit pause for a minute while you're working on this. A quick hint would be to compare your beginning and ending balance if you recall T account analysis from the end of financial accounting. But go ahead and hit pause while you try to work this out. Okay, so the way I would work this problem, I would compare the beginning and ending, 32,000 versus 28,000. That's a difference of 4,000. So immediately I know that my answer, the amount of direct materials used, has to be 4,000 different than 276,000. And if I think a little bit deeper, if it made the balance go down in our raw materials, I must have used more than 276,000. So 4,000 more than 276,000, I should come up with 280,000. So mathematically, we're looking at beginning raw materials, 32,000 plus 276,000 equals 308. And if our ending raw materials is 28,000, we get 280,000. So my T account analysis way, I'm just doing a little bit of mental math, comparing the 32,000 and the 28,000, and saying, okay, my answer has to be 4,000 different than 276. So then we immediately know it's either 280 or 272. And in this case, since the balance in raw materials went down, I know we used more than what we purchased. All right, so we've got our 280. Let's move on to quick check 2. Direct materials used in production totaled 280,000. Great, we just computed that. Then direct labor was 375,000, and $180,000 of MO was added to production for the month. What were the total manufacturing costs incurred? Hopefully this one's short and sweet. Pause for a second while you do your math. So really here, all you're going to do is just add up the numbers. 835,000. We take direct materials plus direct labor plus MO. So our total manufacturing costs incurred are 835,000. All right, let's move on to quick check 3. Beginning WIP was 125,000. Manufacturing costs added to production for the month were 835,000. That number should look familiar. We just computed that. There were $200,000 of partially finished goods remaining in WIP inventory at the end of the month. What was cost of goods manufactured? Meaning what got transferred out of WIP to finished goods. So if you use the T account method, if we look at our beginning and ending, 125,000 versus 200,000, that means our answer has to be 75,000 different than 835,000. So pause for a moment while you do your math. So for me, if I'm thinking it's going to be 75,000 different than 835,000, and the balance goes up during the month, which means that we finished less than 835,000. I'm going to take 835,000 minus 75,000, and I get 760,000. Or you can do the math this way, where we take our beginning WIP plus the manufacturing costs added in during the period, gives us 960. Subtract our ending WIP of 200,000, and we end up with COGMAN, cost of goods manufactured, of 760,000. And that 760,000 is what we're going to transfer into finished goods. So, quick check 4. Over and beginning finished goods was our beginning inventory was 130,000. Then the cog cost of goods manufactured for the month, was 760,000 that we're adding in. And the ending finished goods inventory was 150,000. So what was cost of goods sold? Again, for me, doing T account analysis, I'm looking at my beginning and ending balance, 130 versus 150. That's a difference of 20,000. So the answer I select needs to be 20,000 different than 760,000. And it looks like the balance went up during the month, so we sold less than what we put into the account. So I'm going to take 760,000 minus 20,000. So the correct answer is B, 740,000, and we could do it this way too. We take our beginning 130,000 plus the 760,000 of cost of goods manufactured, gives us goods available for sale of 890,000, and if our ending finished goods is 150,000, we take 890,000 minus 150,000, and we should come up with that same 740,000. So this process of walking through these quick checks 1 through 4 hopefully helped you build some confidence in computing these numbers and believing that you can do a schedule of cost of goods manufactured and a schedule of cost of goods sold. Our next step is to understand and compute our under or over applied overhead and prepare the journal entry to close the balance in MO to the appropriate accounts. So like we've talked about before, MO doesn't show up on our financial statements. We have to empty out the MO bucket at the end of the term or the end of the accounting period. So a few key concepts. The difference between the overhead cost applied to WIP and the actual overhead cost of a period is what we call either under or over applied overhead. So under applied overhead exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is less than the total amount actually incurred, and overapplied is just the opposite. Overapplied exists when the amount of overhead applied to jobs during the period using the predetermined overhead rate is greater than the actual overhead incurred during the period. To me, this is a lot of words and it's kind of hard to understand, just my opinion, but the format in which they lay it out I think is kind of helpful. Let me help you out here. Here I'm drawing a giant T account right over the top of what we've got here. And if this is our MO T account, if we end up with a debit balance on this side, then we're under applied. If we end up with a credit balance on the right side, then we are over applied. So to me, that's the simple way of looking at it. If there's still MO left in the bucket, that's on the debit side, we have more overhead that we need to apply. We're under applied. If we have a credit balance, which represents negative MO, that can't even really exist, then we're over applied and we got to walk some of it back. So we're going to go back to looking at our favorite company, Pearco. Remember that from the previous chapter. Pearco's actual overhead for the year was $650,000. With a total of 170,000 direct labor hours worked on jobs. Their predetermined overhead rate is $4 per direct labor hour. So we're going to take that $4 per DLH and we're going to multiply it by 170,000. So our overhead applied is 680,000. So if we're looking at our actual overhead versus our overhead applied, what do you think? Are we under or over applied? I'm lopping off the zeros because it's too much to write. So clearly we're left with a credit balance. So we're 30, that'll be 30,000 over applied. So we're comparing the 650,000 to the 680,000 that we actually applied. We're over applied by 30,000. So what are we going to do with that? That's what we need to figure out next. Before we do that, try this quick check. Tiger Inc. had actual MO of $1,210,000 and a predetermined overhead rate of $4 per machine hour. Tiger Inc. worked 290,000 machine hours during the period, so their manufacturing overhead is going to be how much? So you need to compare the amount applied versus their actual and figure out how much they are under or over applied. Go ahead and hit pause while you do your math. So as you're doing your math, I'm hoping you came up with 50,000, but we need to figure out if that's under or over applied. And where's that coming from? Our overhead applied is going to be $4 per hour times 290,000 machine hours. You should come up with 1,160,000, and we're comparing that to our 1,210,000 of actual overhead. So if this is MO, we have 1,210,000 on the debit side of actual MO, and then we're going to be applying 1,160,000. So our ending balance is going to be 50,000. Ooh, that's ugly. Let's see if I can write a little bit neater. 50,000 on the debit side. So if it's on the debit side, that means that we are under applied. We have more MO left to be applied. So then we need to figure out the procedure of applying our under applied overhead. Also, we need to figure out what we do if we're over applied. So that'll be what we take a look at next. So next we're going to take a look at the disposition of over-applied and under-applied overhead. And all that means is, what are we going to do with the leftover MO? So any remaining balance in MO, such as Paraco's $30,000 of over-applied overhead, is disposed of in one of two ways. The first way is going to be easier and faster, so we just close it out into cogs. And then the second way, a little more complicated, but often provides a little bit better accuracy, it can be closed proportionally to WIP, finished goods, and cogs. So let's take a look at it just doing it the first way. So the journal entry in T account to close out Paraco's 30,000 of over-applied overhead. So remember, we've got 30,000 extra on the credit side. So to make that go away, we're going to debit MO and then credit cogs. So that's going to bring our cogs down. So we're reducing our cost of goods sold expense. So when we reduce the expense, what does that do to our net income? It's going to go up. So the calculation to do it the other way, the second way, we're going to allocate, or I guess use an allocation to proportionalize that under or over applied amount between WIP, finished goods, and cogs. So if we assume that our overhead applied in ending WIP, ending finished goods, and cost of goods sold is 68,000, 204,000, and 408,000. Let's take a look at that. So we would divide each of those by the total. So if you add 68, 204, 408, we should get 680,000. So if we find the percentage of each of them, so 68,000 divided by 680,000 is 10%, 204,000 divided by 680,000, 30%, 408,000 divided by 680,000 is 60%. So the over-applied overhead in this case, the 30,000, we're going to split up using these proportions. So here's what that looks like. So we've got those percentages, 10%, 30%, 60%, and then we multiply them by 30,000. So 10% of 30,000 will come from WIP, 30% of 30,000 will come from finished goods, and 60% of 30,000 will come from cost of goods sold. And when we put that in journal entry form, we're debiting Mo to bring it back to zero. And then instead of putting all of it as a credit to COGS, we break it out in these proportions. WIP 3,000, finished goods 9,000, cost of goods sold 18,000. If you can recall all the way back to your favorite course, financial accounting, this kind of looks like doing a basket purchase allocation, if that rings a bell. So as we look at these two different methods, the first one was easier, where we just closed all of it out into cost of goods sold. But the second one is considered to be more accurate. It might be a little more complicated to compute, but you can see why allocating it between those accounts might offer more accuracy. It might be somewhat unfair to say that all of it just goes to cost of goods sold, when the reality is those goods that the Mo has been applied to are found throughout WIP, finished goods, and COGS. So how about this? Quick check 6. What effect will the overapplied overhead have on net operating income? And let me clarify that a little bit. What effect will the adjustment to get rid of the overapplied overhead have on net operating income? Pause for a moment while you think about it. So what's going to happen? If we think back to the Pairco example, we ended up crediting COGS. We debited Mo and we credited COGS to make the Mo go back to zero. Well, the credit to COGS is going to decrease the expense and therefore increase net operating income. Keep practicing on the over and under applied manufacturing overhead, and think through what that does to your COGS and to your net operating income. It's a great mental exercise that'll reinforce this concept. So that's it for chapter 3. That's the end. My advice to you would be to spend ample time working on chapter 3 journal entries, and you'll see plenty of that in your homework this week, but do spend plenty of time practicing those journal entries. The slides, I think, in some way oversimplify it, so we need to do some exercises to get plenty of practice on that. All right, you guys, talk to you soon. Let me know if you need help.